We're looking at the consumer price index month over month, comes in double what had been anticipated, up 0.6%. Now that is the performance similar to what we saw in the PPI yesterday. Ex-food and energy also a 0.6 rise. In that case, we were only expecting a 0.2 rise. Pushes the year-over-year numbers to 1% for the CPI headline number, and that's up from 0.6%. So a significant jump in the last month. The core rate goes up to 1.6% from 1.2%. Again, a significant increase over the past month. Taking a look at the breakdown of some of the numbers, the gasoline index accounted for about a quarter of the monthly increase in the headline number, up 2.5% for energy itself. Gasoline 5.6%. Food decreased 0.4%, and food at home down 1.1%, maybe reflecting the fact that more people were able to go out for lunch and dinner to restaurants. The other number that everybody wants to watch on a regular basis is housing. And let's take a look here. The rent of primary residence index, which is the CPI equivalent of home ownership, up 0.2%. That follows a 1/10 gain last month. We'd had a string of 0.3 gains. It does suggest that home prices may be falling a little bit. Maybe at least the price increase is being arrested. We're certainly seeing that in the New York area. And so it may mean that combined with lower mortgage rates, we're going to see a lot more housing activity. We saw the Mortgage Bankers Association numbers jump this morning as we hit new record lows on mortgage rates. So it looks like we're not going to see a major increase in inflation, but we are seeing it move very quickly, and that is one reason we're seeing break-evens on the 5- and 10-year note rise very quickly. We're seeing 5-year break-evens, and hopefully we have the chart here showing that they're up significantly compared to where inflation is. There's a debate in the markets, and Lisa knows more about this than I do, about whether this simply reflects the Fed pinning the short end or whether people are actually believing that we're going to get an outbreak of inflation, guys.
Mike, stay close. I just want to whip through the price action outside of what you were talking about. Looking at equities, a delayed reaction. We roll over just a little bit. Still positive on the day by 19 points on the S&P 500, up around about 0.5%. Outside of equities into the bond market, Treasury yields with a lift going into the number, a lift coming out of it too, up by almost 5 basis points on a 10-year to just about 0.69%. That's your 10-year. Even the 2-year yield, just with the smallest of moves, up about a basis point. Outside of that, if we can get to foreign exchange, the euro still firmer on the day to 117.62, up about 0.2% on the session. Mike McKee, people will take this report. They'll do exactly what you did, go through the individual components, work out what's giving it a lift, and then they'll ask themselves a simple question. What's sustainable? What's a one-off shock? What lasts? What lives with us through year end into 21? How would you respond to those questions, Mike?
Well, right now it looks like what we're getting back to is a little bit more of normal in terms of pricing, given the fact that the economy has opened up a little bit. You see a rise in used car trucks and prices, 2.3%. That was a significant increase, one of the outliers in this report other than gasoline. And it reflects the idea that people are now buying again, but maybe not buying new cars at the same rate that they used to because the economy is running a little bit more slowly. But when you look at the interest rate reaction here, I'm looking at the 5-year breaking its 50-day moving average up to 31 basis points, basically. You're seeing people repricing for a little bit more normal. The question is, do they believe this continues, and do we run into supply shortages down the road that will keep prices rising, or are we just normalizing after a period of unusual weakness?
Yeah, and the 10-year yield also breaking out, as John was mentioning, now up to close to 0.69%. Mike, I find it interesting that you have yields rising and you have stocks selling off slightly, rolling over, not selling off completely, but giving up some of the gains and free market trading. Does this indicate a stagflationary bet that basically people are saying higher prices are just going to reduce the buying power of consumers and not necessarily indicate faster growth ahead? Or does this indicate that the economy is recovering in a meaningful way that will benefit the average consumer?
Well, it's hard to tell from 1 month's data, and we did see a little bit of a rise last month as well. But the anecdotal information is that the economy is running a little bit more slowly than it was in early June, say. So it's going to be an open question on Wall Street for a little while until we get some more specific data. Retail sales coming up. That'll be important in Wall Street's mind to see whether this is a reflection of stronger growth or whether it does imply that there might be some stagflation down the road. We haven't had that since the 1970s. I'm not sure it's coming back, but it is going to be a question for investors for a couple of weeks while we wait to see how the other half, the growth side of this equation, comes out.